The market is closed for the weekend, and Strive Inc., trading under the NASDAQ ticker ASST, finished Friday's session in a difficult spot. The stock closed at $1.08, marking a significant drop of 6.09% or 7 cents for the day. This continues a painful trend for shareholders, who have watched the stock tumble from its 52-week high of $13.40. However, in the after-hours session on Friday, November 14th, there was a small sign of life, with the price ticking back up to $1.09, a modest gain of just under 1%. Now, the immediate expectation when you see a chart like this, a 6% daily drop on a stock already trading near its 52-week low of 34 cents, is that this is a company in serious trouble, perhaps bleeding cash with no clear path forward. The negative P/E ratio on the summary page certainly supports that assumption, but the reality of what is happening with Strive Inc. is vastly more complex and, frankly, more interesting than just another struggling microcap. The company that exists today is almost entirely different from the one that existed just a few months ago. And Friday's 6% drop was not a random sell-off. It was a direct reaction to the company's third quarter 2025 financial results, which were released just yesterday. Let's look at Friday's trading action because it tells a story. The stock opened week at $1.06, well below its previous close of $1.15. There was an initial attempt at a rally in the morning where buyers pushed the price all the way up to $1.28. That was the moment of hope. But it was short-lived. The sellers took absolute control, and the stock bled out for the rest of the day, finally bottoming out at $1.05 before that $1.08 close. The volume was heavy, suggesting a lot of shareholders were capitulating and heading for the exits after seeing the earnings report. So, what was in that report? On the surface, it looked terrible. The company reported a GAAP net loss of $192.3 million. Seeing a number like that on a company with a market cap that data providers are struggling to pin down, some show it in the $600 million range, others closer to $900 million after all the recent financing, would scare anyone. But this is where we have to look deeper. Strive's management was quick to point out that the vast majority of that loss, specifically $179.3 million, was related to non-cash items. This isn't a simple case of a company spending more than it makes on widgets. This is the messy accounting that comes from a radical corporate transformation. And what is that transformation? Strive Inc., through a reverse acquisition of a company called ASST Entities Inc., has repositioned itself as the first publicly traded Bitcoin treasury company amplified exclusively with perpetual preferred equity. That is a mouthful, so let's break it down. Strive is essentially a holding company for Bitcoin. As of November 7th, the company reported holding 7,525 Bitcoin. That is its primary asset. The second part of that business model is the amplification part. The company is using a complex financial instrument, perpetual preferred stock, to raise funds to buy even more Bitcoin. This is a highly leveraged bet. When the price of Bitcoin goes up, Strive's net asset value should, in theory, increase at an accelerated rate. But if the price of Bitcoin falls, that same leverage works aggressively against them. This new identity as a leveraged Bitcoin proxy is the entire story. It explains the 52-week range. That $13.40 high was likely during a period of extreme crypto optimism, and the fall to 34 cents was the brutal crypto winter. The stock is now a direct, high-octane play on the future price of digital assets. And to make things even more complicated, the company just announced it is in the process of acquiring Semler Scientific Inc. in an all-stock deal. This adds another layer of confusion for investors. Why is a Bitcoin treasury buying a medical device company? The stated plan is to leverage Semler's business, but for many, this looks like a confusing distraction from the core Bitcoin treasury thesis. This brings us to the battleground, the short sellers. When you have a complex, highly leveraged, and confusing business model like this, you are going to attract a lot of negative bets, and Strive Inc. certainly has. According to the most recent data from Fintel, the short interest as a percentage of the float is a very high 18.4%. That means for every 100 shares available to trade, more than 18 are held by traders betting the price will go down. This is a significant level of pessimistic sentiment. So, what is the short thesis? The shorts are likely betting on a few things. First, they are betting that this complex perpetual preferred equity structure is unsustainable and will collapse under its own weight, especially if Bitcoin enters another downturn. Second, they're looking at the acquisition of Semler Scientific as a diversification, a desperate move that distracts management and burns capital. Third, they may simply see Strive as an easy-to-borrow proxy for shorting Bitcoin itself, with the added benefit of a confusing corporate structure that could implode. But here's where the story gets fascinating, and it's something every retail investor needs to understand. While the 18.4% short float looks like a powder keg for a short squeeze, other data points tell a different story. The days to cover is only 0.41. This is a critical metric. It means that given the stock's high trading volume, all of those short sellers could, in theory, buy back their shares and close their positions in less than half a trading day. This is not the trapped short scenario you see in classic squeezes. The borrow fee rate, the cost to borrow shares to short, is around 5.8%, elevated but not punitive. It doesn't signal a panic among short lenders. So, if it's not a classic squeeze setup, what is going on? You have to look at the options market. The put-to-call ratio is 0.07. That is an astoundingly bullish skew. It means that for every 100 contracts being traded, 93 of them are calls, bets the price will go up, and only 7 are puts, bets the price will go down. This tells you that while a significant group of professional traders are short the stock, a massive and likely retail-driven contingent is buying up cheap, out-of-the-money call options, dreaming of a return to $10 or $12. This creates a different kind of tension, a potential gamma ramp. If the stock gets any positive momentum, perhaps from a Bitcoin rally, the market makers who sold all those calls would be forced to buy shares to hedge their position, which could ignite a very sharp, very fast move upward. This is a setup that retail investors need to be extremely careful with. If you're looking to understand this, you need to know where to find the data. You can find official short interest data published by FINRA every 2 weeks. You can use services like Fintel or Ortex to get daily estimates on borrow rates and short volume. And you must check the options open interest on your brokerage platform. What's your take on that 18.4% short float? Is it smart money seeing a flaw in the business model, or just a risky bet against a Bitcoin proxy? The options market activity clearly reflects the discussions happening on platforms like Reddit and X. The narrative there is not about the Q3 loss. It is about the 7,525 Bitcoin on the balance sheet. It is about the potential for a squeeze, even if the days to cover metric doesn't fully support it. But this is not just a retail-driven stock. The institutional ownership file is very revealing. Big-name funds like Millennium Management and Hudson Bay Capital are involved. Most notably, Pantera Capital, one of the most respected venture capital firms in the digital assets space, is a major shareholder. This is the smart money on the other side of the trade. They're not buying for a one-day squeeze. They are likely aligned with the company's core mission and are making a long-term, leveraged bet on Bitcoin. So, where does this leave Strive Inc. as we head into next week? The company just raised $762.6 million through a PIPE financing, so it has capital. Its primary asset, Bitcoin, is highly volatile and will be the main driver of the stock price. The expectation, looking at the $0.08 price, is that this is a failing company. The reality is that this is a highly engineered, high-risk financial instrument that is being pulled in 3 different directions: the professional short sellers, the institutional crypto bulls, and the retail options traders. The bull case is simple. Bitcoin rallies hard, the leverage from the preferred equity magnifies the gains, the shorts are forced to cover, the call options go in the good, and the stock moves violently upward. The bear case is just as simple. Bitcoin stagnates or falls, the weight of the leverage and the interest payments on the preferred stock crush the company's value, the Semler Scientific acquisition proves to be a costly failure, and the stock drifts back towards its 52-week low. This brings me to the big question. Based on this new structure as a leveraged Bitcoin holding company, with all the risks and catalysts involved, comment below what you think a fair price for ASST is by the end of the first quarter of next year. Ultimately, the 6% drop on Friday was just noise. It was the market's initial, fearful reaction to a complex earnings report it didn't fully understand. The real story for Strive Inc. is the fundamental tension between its massive Bitcoin holdings and the equally massive complexity of its corporate and financial structure. This is not a stock for the faint of heart. It is a battleground, and the winner will be determined not by Friday's price action, but by the future direction of Bitcoin and by management's ability to execute on this incredibly ambitious and incredibly risky new vision.